In this video, I'll explain everything you need to know about inventory in accounting. We'll start with what inventory is, how businesses recognize and own it, the two main inventory systems, periodic and perpetual inventory system. Then I'll break down inventory costing methods like specific identification, FIFO, LIFO, and FIFO. I'll keep it simple and clear so you can follow along easily. Understanding inventory is very important because it affects companies' profits, taxes, and financial decisions. Stay with me until the end and you'll understand it all clearly. Without further ado, let's get started. So, what's inventory? Inventory is an asset that a business holds for sale in its normal operations or uses to produce goods for sale. There are two main types of businesses that deal with inventory: merchandising businesses and manufacturing businesses. Merchandising businesses like supermarkets and clothing stores buy ready-made products and sell them to earn revenue. So in merchandising business, inventory the goods held by a business that it intends to sell to earn revenue. When we come to manufacturing businesses like car or furniture factories, they create products by using raw materials and turn them into finished goods. So in manufacturing businesses, inventory is the raw materials, work in progress, and finished goods held by a business that it intends to sell to earn revenue. Inventory is crucial for any business. It directly affects sales, cash flow, and profitability of the business. Proper inventory management ensures that products are available for customers and prevent losses from shortage or excess stocks. There are key things to know about inventory. Inventory is a current asset, meaning it's expected to be sold or used within a year. Inventory for one business may not be considered inventory for another. The definition of inventory depends on the type of business. For example, a car dealership considers cars as inventory because they sell them. But a car rental company does not consider cars as inventory because they use them for services. As cars are current assets for a car dealership business, cars are considered as inventory. But in the case of car rental company, cars are long-term assets or non-current assets. So for car rental company, cars are not considered as inventory. Now that you understand what inventory is, let us see how businesses recognize and determine the ownership of the inventory. Inventory should be recorded when a business takes ownership of the goods. But ownership isn't always straightforward, especially when goods are in transit or held by another party. Let us break it down. When goods are shipped, ownership depends on the shipping terms. If the terms are from shipping point, the buyer takes ownership as soon as the good leaves the seller's location. The buyer is also responsible for transportation costs. But if the terms are from destination, the seller keeps ownership until the goods reach the buyer and covers the shipping costs. Now, let's talk about consigned goods. This happens when one business gives goods to another business to sell, but the first business still owns them until they are sold. The one who gives the good is called consignor, and the one who sells them is the consignee. For example, imagine a farmer gives apples to a grocery store to sell. The apples stay in the store, but the farmer still owns them. When customers buy the apples, the store gives some money to the farmer and keeps a small fee for selling them. Since the farmer still owns the apples until they are sold, they stay in the farmer's inventory records, not the store's. In consignment, the consignor, or the owner of the goods, remains the owner until the items are sold. The consignor benefits by reaching more customers without needing their own store, while the consignee benefits by earning a commission without purchasing the inventory. Now that we understand consigned goods and how inventory ownership is determined, let us move on to the two main inventory systems businesses use to track their inventory. There are two main inventory systems that businesses use to track their inventory: the periodic inventory system and the perpetual inventory system. In a periodic inventory system, businesses do not keep a continuous record of inventory changes. Instead, they count inventory at specific times, such as at the end of the month or year. This method is simple and cost-effective, often used by small businesses. For example, imagine a small bookstore that only counts its inventory at the end of each month. During the month, they sell books without keeping a continuous record of each sale. At the end of each month, they count all the books left and calculate how many were sold. This is how periodic inventory system works. In contrast, the perpetual inventory system keeps a real-time record of every sales and purchase. Every time a product is bought or sold, The inventory updates automatically using technologies like barcodes and softwares. For example, large retailers like supermarkets use a perpetual inventory system so that when customers buy a product, the system instantly reduces the inventory count. Understanding the systems is important because they affect how businesses track inventory and calculate their financial statements. Now let's talk about how businesses determine the cost of their inventory. Since inventory costs change over time, businesses use different methods to assign a cost of the goods and the goods they still have. These are called inventory costing methods. The method a company chooses can affect its financial statements, taxes, and profit calculations. The first one is specific identification. This method tracks the exact cost of each item sold. It is used when each item is in inventory is unique, like cars at a dealership. Since each car has a different price, the cost recorded is the exact amount paid for that specific car, which means cost of goods sold is equal to cost of each specific item sold. Now let us see FIFO or first in, first out method. This method assumes the oldest inventory is sold first. It works best for businesses selling perishable goods like grocery stores and pharmacies. For example, older milk is sold before new milk to prevent spoilage. FIFO results in lower cost of goods sold and higher reported profits when prices are rising. This means cost of goods sold is equal to cost of oldest inventory times quantity sold. The next method is LIFO or last in, first out method. LIFO assumes the newest inventory is sold first. It is often used in industries with rising costs, such as oil and gases. Since newer, more expensive inventory is recorded as sold first, LIFO results in high costs of goods sold and lower taxable income. However, LIFO is not allowed under international accounting standards or IFRS and is only permitted in some countries like United States. So in LIFO method, cost of goods sold is equal to cost of newest inventory times quantity sold. Now let us see weighted average cost or FCO. This method calculates an average cost of an inventory and applies it to each unit sold. It is useful for businesses selling identical products in large quantities like hardware stores selling screws. So in this method, average cost per unit is equal to total cost of inventory over total units available. So from that, we can calculate cost of goods sold, and it's equal to average cost per unit times quantity sold. Choosing the right method depends on the type of business and financial goals. Some methods reduce taxable income, while others provide a more accurate picture of profits. Understanding these differences is essential for making smart accounting decisions. If you find this video helpful, like, share, and subscribe for more accounting lessons. See you in the next video.